Hi, everybody. You've got Derek and Brian and Jake of Bore Insurance Group here today. We're going to touch on something that a lot of our clients have been asking about, and rightfully so. You've seen it all over the media, in the news, and pretty much in every aspect of your life. That is inflation. Brian, Jake, thank you for joining me today and providing some of your own commentary as we touch on this subject that has been prevalent for a few years now, but has become even more prevalent today. So inflation and your insurance, we're going to dive into this and keep it pretty brief, but touch on inflation from an auto and from a homeowner's insurance standpoint. Overview of inflation. Brian, you used to be a CPA. You are probably at least somewhat qualified to comment on this. Give us a quick explanation of what inflation is and what causes it.
That feels like a long time ago, and that CPA license has been hanging in the rafters for several years now. But inflation, most of us understand how inflation works, or at least we see the final result of inflation. It might be greater gas prices, it might be a higher grocery bill. It gets reflected in many different segments of our economy. What is it? It's rising prices, services, goods, things all across the board. Real estate, inflation is very wide reaching, and it's caused by, well, it depends on who you ask. It could be one of any 100 or one of any 1,000 factors. But at the heart of it, inflation is caused by excess money being in the system or a shortage of goods and services being available for purchase. At the end of the day, it's supply and it's demand. When you have more money than you have supply of goods and services that want to be consumed, of course, we're going to see rising prices across the board. That's certainly not an explanation worthy of a CPA, but as about a second or third grader, there you go. That's your summary of inflation.
That makes sense. And I think it's important to note that you said prices, and pretty much everything in life that you come across has a price associated with it. You've got the gas pump, you've got construction and real estate, but you've also got things like medical care, and you've got things like labor, and you've got raw ingredients that are going into production of food, et cetera, et cetera. So not only do you see it on the price tags when you're grocery shopping or you're filling up your car, but it infiltrates the entire economy, starting at that very, very ground level. And that's a big reason that inflation has an impact on auto and homeowners insurance. Auto insurance. Jake, what is your favorite question that you get asked by your clients?
Classic. My car gets older every year. Why doesn't my auto insurance decrease?
Yep. And hey, that's a valid point. I think people see their car getting another ding or scratch, and that rust bar is starting to grow just a little bit bigger. Hey, why isn't my auto insurance policy premium decreasing along with the value of my vehicle? We're going to touch on that.
Well, I thought the most important question would be, Jake, which model of Corvette do you like? I noticed that we've got the C8 missing on there, but that's a great example of showing, generational changes in a vehicle over the course of time. Back to the subject, though. Thanks, Derek.
So my car gets older every year. Why doesn't my auto insurance decrease? And in this respect, we're talking about your Subarus and your Impalas and your Corollas. We're not talking about the old classic Corvette that probably is usually increasing in value, even in times that aren't as strange as they are today. But sure, when you think about it, an auto insurance policy, it's designed to repair your vehicle if it's involved in an accident, or if the repair cost is so excessive, to pay you out whatever the market value was immediately before that accident occurred. So really, we're looking at repair cost in most cases when there is a car accident. So what drives those repair costs? Well, the price of the parts and the price of the labor. So as inflation drives those things up, the repair cost becomes higher and higher each and every year. So for example, if you've got a 2018 Chevy Equinox and you have to replace the front fender, the hood, and both of the headlights, well, it's going to cost the same as doing that on a 2014 or a 2015 Equinox. So even though there's maybe a substantial difference in the value of each of those vehicles, as long as it's being repaired, the repair cost is identical, right?
Yeah, and like you said, Derek, those costs at the body shop are just ballooning so fast. And not that the body shops are gouging or making ridiculous profits, but the cost that they're paying to source those parts and to pay the labor for the techs and the repair people, they're increasing very rapidly. I mean, how many times in the past 12 months have you had a client say, "Yeah, this happened in the parking lot," or "That happened at home," but it's probably not going to be that expensive. I'll get an estimate and I'll probably just pay it out of pocket. And they come back and they say, "Holy smokes, it's going to be $4,400 to repair that little bit of damage to my car." We see that all the time. And yeah, maybe in the past that was something you'd pay out of pocket and sweep it under the rug. But today the repair cost of vehicles is just climbing so greatly that many of those small dings end up being very expensive to repair.
And the body shop's not trying to drag you or the insurance company over the coals. They're pricing that based on the cost of those parts from their manufacturer, and that manufacturer is basing it on the cost of the raw materials that go into it, the transportation, the labor to do the repairs, et cetera, et cetera. And in this type of inflationary environment, unfortunately, the cost of all of those is increasing. So you say, well, what if it is a total loss, right? It doesn't matter, what the repair cost is. I'm only concerned about the value of the vehicle because it was totaled. You don't even have to pay those increased prices for the labor and for the parts and for the transportation, et cetera, et cetera. You're just going to pay me out based on the value of the vehicle. Well, let's think about your typical year before 2020. Most people saw the value of their vehicle decline by a couple $1,000s every year with depreciation, right? So we've got a little calculation on this next page here. Brian, when you ask clients, what's the likelihood that they are involved in a car accident in the next year, what do you typically hear from a percentage standpoint?
Yeah, well, your average person has an auto insurance claim roughly every 5 to 6 years. Most of us think we're better drivers than we probably are, and that we're less at risk than we really are. Many people will say that they expect that there's maybe a 10% chance, anywhere from 8 to 14% chance that they'll be involved in a car accident sometime in the next year.
Makes sense. I hear that same thing. So let's say 10% on average for a chance of being involved in a car accident in the next year. Of those people, you say, well, okay, let's assume there is a car accident. What's the chance that that accident results in a total loss to your vehicle? I typically hear about 1 in 4, and I think that's actually fairly accurate based on what we see as an agency. So 25% chance that if there is a car accident, it's going to be totaled. So there's a 10% chance of a car accident, 25% chance of that 10% that it would be totaled. That gives you a 2.5% chance that the vehicle will be totaled in the next year. So let's say you've got that 2018 Chevy Equinox. It's worth $20,000 the first year. There's some depreciation of the vehicle in year 2, and it's worth $18,000 at the end of that next year, right? So it depreciated $2,000. Well, what was the change in risk to the insurance company for insuring that vehicle? Well, from year 1 to year 2, it decreased $2,000 in value. There was a 2.5% chance that it was going to be totaled, because the only time you care about the value is if the vehicle is actually totaled. That's a $50 per year change in the risk to the insurance company. So as that vehicle continues to get older, yes, you will occasionally see the cost of the physical damage coverage for it decline, but it's such a minimal piece of the policy that the inflation on all of the other components of it will typically continue to keep the auto insurance premium stable, if not drive it upward a little bit, depending on specific characteristics of the policy and that time period.
The key point of this slide being simply that the vast majority of auto insurance claims involve repairs to a vehicle. So whether that vehicle is worth $8,000 or $80,000, it really doesn't make much impact if you're paying for the repairs to that vehicle. Likewise, you'll see clients go from a $30,000 Subaru to a $60,000 F-250, and their insurance costs will hardly change at all. And that's interesting. They love it, of course, because they've got a ton more money driving down the road than they did in their old car that they traded in. But to the insurance company, they know that it's highly unlikely that vehicle is going to be totaled. It's much more likely they'll be paying for repairs if it's involved in a car accident. So it's really the repair cost or the expected repair cost of a vehicle that's going to determine very much in terms of the insurance premium.
Good point. Good point. So if the vehicle is going to be repaired, the value doesn't matter. If it's going to be totaled, it does matter, but the value declines so minimally each year, and the chance of it actually being totaled is so small that that doesn't have much of a bearing on the actual cost of the insurance policy. And when you think about recent years, you're not seeing a $2,000 decrease in the value of each of the vehicle each year. We've seen most people, have an increase in the value of their vehicle each year, ever since 2020. So kind of a reverse environment that we have going on right now, but that's of course driving insurance costs as well.
And a common question when a vehicle is potentially totaled or is going to be totaled is that valuation of my vehicle going to reflect today's market prices? Is it going to account for inflation that we're seeing? And it does. The valuation company, it's generally a third party, and they'll go out and they'll look at 6 or 8 or 10 other comparable vehicles for sale in the area, and then make adjustments based on mileage and condition and that kind of thing. But they're trying to estimate, hey, in today's environment, what would this car have been worth the day before it was involved in that car accident that totaled it?
That's right. That's right. You've got another part of the policy as well that is not based at all on the value of the vehicle or the repair cost to it. And that's the lawsuit protection, your bodily injury liability coverage, your property damage liability coverage, your medical coverage. You've got these other components of it that are not impacted by the value of your vehicle. So even if the value of the vehicle is decreasing each year, like it would in most normal years, these coverages are actually typically increasing along with inflation, because medical costs, as we all know, have been increasing each year. Lawsuit values have been increasing each year. There's just so many pieces of the policy that are not based on the value of a vehicle that inflation is really going to drive those up. Another point here is that if you've always had $100,000 of liability coverage on your auto insurance policy for, let's say, the last 10 years, well, that $100,000 is much more likely to be used today because of a lawsuit than it was 10 years ago, because lawsuit values are higher. People are earning more money. Some of that's based on inflation, but the value of their assets and everything else is higher today than it was 10 years ago. So even if your coverage amount has remained stagnant for the last 10 years, it's more costly because each dollar of coverage is more likely to be used today than it was 10 years ago. Homeowners insurance.
All righty, I will take over from here. Thank you,
Go for it.
Eric and Brian. So when it comes to homeowners insurance and increasing costs, the primary driver of that is going to be, of course, the anticipated potential claim payouts. In an inflationary environment, those anticipated claim payouts are, of course, going to be increasing. When it comes down to it, we really have 2 different claim scenarios here. First one, to rebuild the home. This is a worst case scenario, a total loss. Over time, insurance companies automatically increase your level of dwelling coverage to keep up with inflation. In past years, this has been 2.5% to 3.5%. This year, they've bumped that up to 7% to 8%, upwards of 10% in some cases, just to keep on pace with that. And then in addition to just keeping up with inflation, they also need to keep up with increased building costs. There's been a number of supply issues this year, increased labor costs that are also driving to increased construction costs if, God forbid, there was a total loss for your home.
Yeah, I think just to interject, Jake, I think it's all based on the function, the primary function of a homeowner's policy, and that is to rebuild the home brand new based on today's labor and material costs, right? So it doesn't matter if the house is 20 years old or 200 years old when it is entirely destroyed by a fire or a tornado or something like that. The insurance policy is designed to rebuild an identical structure today. So they're going to say how many square feet, what style of home, how many bathrooms, finished basement, attached garage, et cetera, et cetera. We're going to build that thing brand new. So the total coverage amount on that homeowner's policy should be the estimated cost to rebuild an identical structure today. And that's obviously going to be impacted very heavily by inflation and current construction demand.
Yep, absolutely. The second scenario we have here is for a smaller claim, a $5,000 to $30,000 claim where there's a partial loss in the home, but it's not a total loss. It needs to be reconstructed from the ground up, brand new, as Derek mentioned. Again, inflation is going to, of course, contribute to increased cost with this. But when we're in an environment like we are today with increased labor costs, material costs, and things like that, those smaller jobs are going to be a lot less desirable for contractors to take on. So we're in an environment now where no one really wants to take on a $5,000 job, and naturally that's going to drive up the cost of those smaller jobs. So essentially the cost of each dollar of coverage is getting more expensive as we kind of get further into this.
I've actually seen several scenarios in the past few months, Jake, where a claim was approved, the claim payment was issued based on the contractor or the shop's initial repair estimate. And by the time that work actually got done 3 or 4 or 5 months later, the shop said they couldn't do it, or the contractor said they couldn't do it for that approved estimate that they submitted only months beforehand. They said, hey, this is going to cost another X number of dollars to do it today because of where inflation has taken things. So very interesting that you can't turn around and get that work done right away. And if there's a delay, sometimes that initial repair estimate that was approved by the insurance company has to be opened back up and then adjusted. Just simply because of the timing between when the payment was issued and then when the work is actually being scheduled.
Yeah, we're definitely in a wild environment right now. Things change so fast, and it's a little bit crazy.
That's very true. And I think also just to tack on another point to that is when you look at a homeowner's policy, you know that the total coverage amount is the expected reconstruction cost of the home, but each layer of, let's say, $10,000 to get up to that total amount, well, the insurance company knows what types of claims are likely going to use those different levels of coverage. So you've got a leaking refrigerator or a burst pipe or something like that. Well, yeah, that's going to certainly use that 0 to 10,000 level of coverage, but it's probably not going to hit that $25 to $35 to $45,000 level of coverage like a terrible windstorm would that ripped off all the siding and destroyed the roof. Well, today that leaking refrigerator, it might hit that $30, $40, $50,000 level of coverage because the flooring costs are so high and the labor is so high, et cetera, et cetera. So the same type of claims that used to be handled for $5,000 or $10,000, like you mentioned, Jake, because of all of the demand and the supply and labor issues, those are now costing $30,000, $40,000, $50,000. So we're going to see that, of course, in the cost of each dollar of coverage on the policy, like you had mentioned.
Sure. So, Jake, Derek, inflation, of course, is here. Who knows how ugly it gets? Who knows when we get past it? But what do we do about it? What's the answer?
Well, as insurance nerds, I think the most important thing to us is to ensure that coverage amounts are adequate, right? The last thing somebody wants is for their house to be entirely destroyed and then find out that they didn't have the adequate amount of coverage to rebuild that thing. And now they're trying to cram the whole family into a 2-bedroom, 1-bathroom house instead of a 4-bedroom, 2.5-bath house, right? Also, use higher deductibles. The higher the coverage amounts are, the more important it is to have higher deductibles to keep someone's insurance budget in check. Take advantage of paid in full discounts. If you've got the funds available, with interest rates where they are today, you're going to be better off taking advantage of the paid in full discount. It's usually somewhere between 6 and 15% with most insurance companies. Do that, and instead of leaving that money in your checking account that's earning 0.5%. Lastly, focus on the most important aspects of your insurance. There are a ton of pieces of insurance that really impact your ability to build wealth and to build financial security. Umbrella policies, liability coverage on your auto insurance, having the appropriate amount of coverage on your home itself. Focus on those and focus a little bit less on maybe rental reimbursement coverage on your auto insurance or the collision deductible on your auto insurance, et cetera, et cetera. Take some of that little risk off the table, focus on those bigger ticket items. So you've protected yourself and your family, from a large scale when it comes to your financial stability, but you can take a little bit of that, day-to-day or weekly risk into account with regard to what you're going to pay in the event of a claim.
Sure.
Brian, Jake, that wraps it up. Thanks for joining me and sharing your insight on this. Everybody else, feel free to chat with us. We'd be more than happy to talk about inflation, auto insurance, homeowners insurance, umbrella insurance, anything you'd like. So feel free to reach out to any of us via phone 616-363-7766 or via email. All of our email addresses are available on our website, boerinsurance.com, BOER insurance.com. Thanks, gents. Talk to you guys soon.
Thanks.
Thanks.